Imagine this. You stop at a coffee shop on your way to work. $4, that is all you spend. You tap your card, grab the coffee, and forget about it before you even reach your desk. 3 days later, you check your bank account. The balance is negative $31. You stare at the screen because you know you had money in there. Then you see it, a $35 overdraft fee. That $4 coffee just became a $39 financial mistake. You call the bank, hold music. 5 minutes, 10 minutes, 20 minutes. Then someone finally answers and tells you the fee is valid. You ask if they can reverse it. They say they can review the account, but there are no guarantees. You explain that you normally keep money in the account. You explain that your paycheck is coming Friday. You explain that it was a mistake. None of it matters. The system has already made a calculation about you, not about your personality, not about your work ethic, not about whether you are a good person, not even about whether you will eventually become wealthy. It has looked at a number, your balance, your transaction history, your overdraft history, your risk score, and for a moment you are not a customer. You are a risk category. Now imagine the exact opposite situation. Imagine you walk into the same bank with $25 million. Suddenly, nobody is asking you to prove that you deserve attention. The institution is asking how it can make sure you never move your money somewhere else. The banker knows your name. The banker knows your assets. The banker knows your family structure. The banker may know that you are considering buying another property, setting up a trust, changing your estate plan, or moving assets between investment accounts. You are not being charged for making a mistake. You are being offered customized terms because the bank wants to keep your relationship. Same institution, same doors, same logo on the wall, same checking account technology, but a completely different world. And here is the uncomfortable part. You are the same person at every balance. If you have ever wondered why banking can feel strangely expensive when you have less money and strangely generous when you have more money, stay with me because we are going to walk through 8 different levels of the banking system, one balance at a time. By the end, you will see why a bank can treat one customer like an inconvenience and another customer like a business partner. And more importantly, you will understand the financial structure underneath that behavior. If you enjoy finance explained without the usual Wall Street noise, subscribe to David Marshall Finance because this channel is about understanding the systems behind your money, not just watching numbers move on a screen. Now let us start at the bottom because that is where the system becomes easiest to see. Level 1 begins when your account goes negative. Picture a fictional customer named Daniel Carter. Daniel works a regular job. He pays rent, buys groceries, fills the gas tank, pays his phone bill, and tries to keep a little money in checking. One Tuesday morning, he buys that $4 coffee, nothing unusual, but a pending transaction clears before his paycheck arrives. His account drops below zero, then comes the overdraft fee, $35. Now Daniel owes $77 in total. $4 for the coffee, $35 for the fee, and the rest from the original shortage and other pending activity. $77 may not sound enormous if you have hundreds of thousands of dollars sitting in an investment account. But when your checking account is already close to zero, $77 changes your week. Daniel skips lunch, he delays filling the gas tank, he moves money between accounts. He watches his phone because he is waiting for payday. That is where emotional isolation begins. Scarcity does something strange to the human brain. It narrows attention. You stop thinking about 5 years from now and start thinking about Friday. You stop thinking about building wealth and start thinking about avoiding another fee. And the bank does not need to understand your entire emotional experience to make a decision about you. Its systems are designed to detect risk, calculate probability, and price services accordingly. Daniel calls again. He gets another round of hold music. A representative tells him that the fee can sometimes be reversed for certain customers, depending on their account history and bank policy. Daniel feels like he is negotiating for mercy. But somewhere else inside the same organization, a computer is doing something completely different. It is asking a much colder question. How profitable is this relationship? How expensive is it to serve? What is the probability of future losses? What products does this customer use? How much money stays here? The system isn't broken. It is working exactly the way it was built. Retail banking is designed to serve millions of people efficiently. That means standard rules, standardized products, automated decisions, and limited human attention. At the bottom of the balance ladder, the customer often pays for the cost of that infrastructure through fees. Daniel is not necessarily being punished because the bank dislikes him. He's being priced according to the economics of the relationship. And that distinction matters, because once you understand it, the next level becomes much easier to understand. Level 2 is $200. This is where the relationship can start feeling less like an emergency and more like a permanent financial treadmill. Imagine Daniel gets paid, his balance rises to $200. For a moment he feels relief, but then the monthly account fee appears, $12, maybe $15, unless he meets certain conditions. Perhaps he needs a direct deposit, perhaps he needs a minimum balance. Perhaps the bank requires $1,500 in the account to waive the fee. Daniel has $200. The requirement is $1,500. That gap matters. He's not just short of money, he's short of access to the cheapest version of the product. And then he gets another offer, a secured credit card. Deposit $300 as collateral and receive a credit line backed by your own money. For someone rebuilding credit, a secured credit card can be useful. But emotionally, the message can feel strange. You are being asked to prove that you can handle borrowed money by first giving the bank your own money as collateral. Again, this is not necessarily a scam. It is risk management. Collateral reduces the bank's exposure. A secured credit card gives the institution a safety mechanism. But look at the broader picture. Daniel needs to build credit. He needs to avoid fees. He needs to maintain a balance. He needs to build savings. Yet the financial products available to him often require discipline precisely when discipline is hardest to maintain. This is one reason the class divide in banking can feel so powerful. Wealth gives you room to make mistakes. Scarcity makes small mistakes expensive. A person with $20,000 in liquid cash can survive a surprise bill without touching a credit card. A person with $200 cannot. The first person has optionality. The second person has timing problems. And banking systems respond differently to those realities because the economics are different. Now watch what happens when Daniel finally crosses another threshold. Level 3 is $2,000. $2,000 does not make someone rich. It does not buy financial independence. It does not transform a person into a wealthy client, but it can change how the banking relationship feels. Daniel now has enough money flowing through the account that his direct deposit is predictable. He keeps a more stable balance. The overdraft problem disappears. The monthly maintenance fee may be waived because he meets the bank's requirements. Then something else happens. He receives a pre-approved credit card offer. The language is different. There is less suspicion and more invitation. His relationship with the bank has become easier to manage because the bank has more evidence that he is financially predictable. Daniel needs an 11% loan for a car repair. He still does not get the best rate in the market, but he can qualify, and this is where people often misunderstand credit and banking. Banks are not simply asking, is this person good or bad? They are asking, what is the probability that this person will repay us and what return compensates us for the risk? The better the bank can predict your behavior, the easier it becomes to price your relationship. Stable direct deposit, stable balances, fewer overdrafts, regular payments, those signals create a different profile. The human being has not changed. Daniel is still Daniel. His rent is still due. His car can still break, his job can still disappear, but the data surrounding him has changed. You are the same person at every balance. The number changes the institution's perception of you, and that perception changes the products placed in front of you. But there is a much bigger shift coming because eventually the relationship stops being primarily about products and starts becoming about people. That happens at level 4, $15,000. $15,000 in one banking relationship is enough to make the customer more economically interesting. Daniel now has a meaningful cash reserve. His income is stable. His deposits are predictable. His account is no longer constantly generating problems. Then one day, instead of dealing with a general customer service queue, Daniel gets introduced to a relationship banker. This person has a name, a desk, a phone number, an incentive to understand Daniel's broader financial picture. Suddenly, the bank knows he is considering a new car. Daniel receives a $9,500 credit limit. He qualifies for an auto loan around 6.8% depending on his credit profile and market conditions. And if an optional account fee appears that should not be there, Daniel calls his relationship banker. The fee may be reversed immediately. Think about how different that experience feels from the $77 problem at the beginning. At the bottom, Daniel was calling the institution. At this level, the institution has created a person whose job is partly to maintain the relationship. That is the beginning of personalized service. And personalized service is not just about being nice. It is an economic decision. A bank is willing to spend more human time when the expected value of the relationship justifies that expense. That means something uncomfortable. Service itself can become a form of financial class. The person with less money gets an automated message. The person with more money gets a person. The person with less money waits on hold. The person with more money has a direct number. The person with less money has standard terms. The person with more money may have someone advocating internally on their behalf. The system isn't broken, it is working exactly the way it was built. But now we reach a level where the difference becomes even more obvious. Level 5 is $80,000. At $80,000, the customer may qualify for preferred client status depending on the institution and the products being held there. Suddenly, communications become more personalized. The bank may know when Daniel's certificate of deposit is maturing. It may know when his mortgage is approaching a refinancing decision. It may send a message from a specific banker instead of a generic marketing address. Then Daniel gets a mortgage opportunity, $400,000 pre-approval. The number is important, but the process is even more important. Daniel is no longer just shopping for a mortgage. The bank has an incentive to win the mortgage relationship. And if another financial institution is competing for his assets, something fascinating can happen. A bidding war begins. Not necessarily a literal auction in a conference room, but a competition over rates, fees, services, lending terms, and the broader relationship. At this point, Daniel has something more valuable than money itself. He has financial leverage. Banks want deposits because deposits can support lending and other activities. They want investment assets because those assets can generate management revenue. They want mortgage relationships because lending generates interest income. They want customers who use multiple products because the relationship becomes more valuable over time. This is relationship scaling. The more economically valuable the relationship becomes, the more resources the institution can justify putting behind it. And this is where the emotional experience of banking begins to reverse. At the lower levels, you're worried that the bank might charge you another fee. At the higher levels, the bank is worried that you might move your money somewhere else. That is a profound psychological shift. Scarcity makes you afraid of losing access. Abundance gives you the ability to negotiate access. Now we move to level 6, $500,000. $500,000 changes the conversation again. Daniel may now encounter wealth management. Instead of simply asking where he wants his paycheck deposited, the institution can discuss asset allocation, retirement planning, tax structure optimization, estate planning, insurance, investment accounts, and potentially trust structures. The language becomes more sophisticated because the financial problem has become more sophisticated. At $500,000, the institution may have colleagues from wealth management reaching out directly. In some situations, the service can become almost surreal compared with the experience at the bottom. A banker may drive to meet the client. There may be private dinners. Certain wire transfer fees may be waived. Meetings are scheduled around the client's calendar. The institution begins organizing itself around the customer's convenience. Remember that cold pizza on a kitchen counter after a long workday. Remember Daniel staring at a negative balance on his phone, wondering whether a $35 fee could be reversed. Now imagine a banker driving across town because the client has a scheduling conflict. The difference is not simply luxury, it is institutional economics. At $500,000, the bank can see a relationship that potentially extends across decades. Asset management can generate revenue. Lending can generate revenue. Deposits can support the broader banking operation. Estate planning can create additional services. Tax structure optimization can create value for the client while strengthening the relationship. Generational wealth can turn one client into a multi-generational relationship. That is why the bank is willing to invest more heavily in the experience. The customer has become an asset to be retained, and once you understand that, the final two levels become almost impossible to ignore. Level 7 is $5 million. $5 million changes the customer from a preferred client into a potential private banking relationship. Private banking operates differently from ordinary retail banking. The client may have a dedicated banker, specialists across lending and investment services, and access to more customized solutions. Instead of a menu of standard products, the conversation can become about what the institution can structure. The bank might discuss bespoke interest rates depending on the relationship, the collateral, market conditions, and the overall transaction. It may coordinate lending against assets. It may help organize complex cash management. It may connect the client with specialists in estate planning, trust structures, asset management, and tax-related strategies. The banker may have fewer than 20 clients depending on the institution and role. That changes the economics of attention. A retail banking representative might interact with thousands of customers through standardized systems. A private banking relationship manager may be responsible for a much smaller group of highly valuable relationships. The difference is not accidental. It is the same principle operating at a higher level. The institution spends more because the relationship is worth more. At this level, investment minimums can sometimes be negotiated or waived depending on the broader relationship and the institution's policies. The client may have access to investment opportunities that ordinary customers never hear about, but there is another psychological transformation happening here. The customer is no longer primarily asking, "What does the bank offer me?" The customer can ask, "What can the bank build for me?" That is the moment the relationship changes from consumer to partner. And yet even $5 million is not the top of the hierarchy, because when the number becomes 25 million, something even stranger happens. Level 8 is $25 million. At $25 million, the institution may stop thinking about you as simply a wealthy customer. It may think about you as an institutional relationship. The vocabulary changes again: customized investment terms, bespoke investment deals, complex asset management, liquidity planning, estate planning, trust structures, tax structure optimization, generational wealth, emerging markets, international exposure, concentrated positions, large credit facilities. The conversations can become highly customized because standard retail products are no longer sufficient for the financial complexity involved. Imagine Daniel sitting at a long wooden table in a quiet conference room. No crowded branch, no fluorescent lights, no hold music. There is a leather folder in front of him. Across the table is a senior banking executive. They are not asking Daniel whether he can afford the monthly account fee. They are discussing where capital might be allocated over the next decade. The bank chief may want to understand Daniel's view of emerging markets. They may discuss liquidity needs, investment structures, succession plans, and how assets should move across generations. The institution is no longer simply selling Daniel a checking account. It is trying to become part of the architecture of his wealth, and that is the highest expression of relationship scaling. The bank is willing to customize because customization helps preserve a relationship worth millions of dollars in future revenue, deposits, lending, asset management, and referrals. This is where the class divide becomes almost impossible to ignore. At the lowest level, the institution's question is, how do we protect ourselves from this customer? At the highest level, the question becomes, how do we protect this relationship? Same human being, same name, same phone number, same financial history, different number, different economics, different treatment. You are the same person at every balance. Now here is where the story becomes more interesting, because the banking hierarchy does not necessarily measure human worth. It measures economic value to the institution. That distinction is critical. Someone can be brilliant, generous, hardworking, honest, and responsible while having very little money in the bank. Someone else can have enormous assets and still make terrible personal decisions. Banking systems are not designed to measure moral character. They are designed to manage financial relationships. That is why the experience can feel so dehumanizing at the bottom and so intimate at the top. The system is optimizing for economics, and that leads us to the cyclical paradox. Think about Daniel at $25 million. Now imagine something goes wrong. His assets fall. His business suffers. He needs liquidity. Markets decline. His portfolio drops. He moves money. Suddenly, some of the leverage he once had begins to disappear. The relationship may still be valuable, but the economics have changed. Now reverse the story. Imagine Daniel starts at negative $77. He avoids overdraft fees. He builds a small emergency fund. He establishes direct deposit. He gets his balance to $2,000, then $15,000, then $80,000, then $500,000. He begins investing. He learns about asset management. He learns how estate planning works. He understands trust structures. He becomes intentional about tax structure optimization. His assets grow. His financial behavior changes. And as his balance grows, the bank's treatment can change with him. This creates a strange feedback loop. Money gives you better access to financial infrastructure. Better financial infrastructure can make it easier to preserve and grow money. More money creates more negotiating power. More negotiating power can create better terms. Better terms can reduce friction. Less friction can make wealth easier to manage. Meanwhile, at the lower end, fees and scarcity can create the opposite loop. A small mistake creates an overdraft fee. The fee reduces the balance. The lower balance creates more financial pressure. Pressure increases the chance of another mistake. Another mistake can create another fee. The customer spends more energy managing short-term problems and less energy building long-term assets. This is not proof that every bank is evil. It is something more complicated and in some ways more important. Incentives shape behavior. Banking institutions respond to incentives. Customers respond to incentives. The result can create a system where money attracts money because the cost of serving wealthy customers can be justified by the revenue those relationships generate. And the cost of serving smaller customers can be managed through automation, standardization, and fees. The system isn't broken. It is working exactly the way it was built. But that does not mean you have to remain at the level where the system has the least leverage over your life. The lesson is not to become obsessed with reaching a magical balance because a banker will suddenly treat you differently. The lesson is to understand what your money is doing. Your first goal may be stability, then liquidity, then a reliable emergency fund, then consistent investing, then debt management, then retirement planning, then asset management, then estate planning. The numbers matter because they create options, and options are the real currency behind financial independence. Someone with $5,000 in emergency savings has options that someone with $500 does not. Someone with $50,000 invested has options that someone with $5,000 does not. Someone with enough assets to cover years of expenses has options that a person living paycheck to paycheck does not. Wealth is not simply about buying expensive things. It is about reducing the number of decisions that can be forced upon you by financial emergencies. And this brings us back to the $4 coffee. The coffee was never the real problem. The $35 overdraft fee was never the entire problem either. The deeper problem was that one small mistake could create a chain reaction because there was no financial cushion between Daniel and the consequences. That is scarcity. Scarcity makes ordinary life feel like a series of traps. Abundance does something different. It creates breathing room, and breathing room creates better decisions. Better decisions can create stronger balances. Stronger balances can create better financial opportunities. That is the paradox. The system can feel like it rewards people who already have money, and in many ways, financial infrastructure does become more flexible as assets increase. But you can still use that knowledge to build your own leverage. You do not need $25 million to start. You need to understand the direction, move from financial fragility toward stability, move from stability toward consistency, move from consistency toward ownership, move from ownership toward options, then use those options intelligently, because the ultimate goal is not to make a banker impressed by your balance. The goal is to make your balance give you freedom from unnecessary financial pressure. One day, the phone call that once terrified you may become irrelevant. One day, a surprise car repair may be an inconvenience instead of a crisis. One day, a job change may be a decision instead of a disaster. One day, retirement may stop looking like a date on a calendar and start looking like a choice. That is what the numbers can eventually buy you, not status, not a private dining room, not a leather folder, freedom. And if there is one idea I want you to remember from this entire journey, it is this. You are the same person at every balance. The bank may see a different risk score. It may see a different revenue opportunity. It may offer different products. It may assign a different banker. It may change the terms. It may suddenly return your calls faster. But your identity did not change when the balance changed. What changed was your leverage. And understanding that distinction can change the way you approach money forever. So the next time you look at your bank account, do not just ask how much money is there. Ask what that money allows you to do. Does it protect you from an emergency? Does it prevent one small mistake from becoming a financial crisis? Does it give you negotiating power? Does it create investment capacity? Does it reduce your dependence on expensive debt? Does it help you build generational wealth? Because eventually the most powerful thing your money can do is stop making you feel like the bank owns the rules of your life. The institution may always have its tiers. Retail banking will always have its standardized systems. Wealth management will always have its specialized services. Private banking will always have its customized relationships. But your objective should be bigger than reaching the next tier. Your objective should be reaching the point where your financial life has enough strength that one unexpected event cannot knock everything over. Because at the end of the day, Daniel was never the number on the screen. Neither are you. The number is simply a measurement of the financial leverage you have built. And once you understand that, you stop asking why the bank treats people differently. You start asking the more powerful question. What can I do to make sure my money gives me more choices than it took away? If this video changed the way you look at your bank account, subscribe to David Marshall Finance. We are going to keep breaking down the hidden systems behind money, wealth, investing, economics, and financial psychology so you can understand not just what the financial world is doing, but why it is doing it. Because the better you understand the system, the less likely the system is to control you.